Well, the Reserve Bank this week has kept interest rates on hold again, but I love the diplomatic language around this. The marketplace always listens carefully to how the Reserve Bank delivers its announcement. There is talk that rates will go up, maybe as early as June, and the question is, what do you do with your home loan? And this comes at a time where there's so much uncertainty. We're talking not only about the Australian economy, but the conflict in Europe, other varying factors, a looming federal election, for example. And in a lot of places across Australia, property prices for the first time in a long time appear to be softening. So, putting all those factors together, we thought we'd talk to Carl Hammerschmidt, the CEO of Joust Online Home Loans. He joins us now. G'day, Carl.
G'day, Bill. How are you?
I'm well, thanks. And the government has tried to entice, that is federal government, tried to entice first home buyers into the market with the Home Guarantee Scheme. Now, this means smaller deposit for first home buyers and no mortgage insurance. Has that worked?
Well, look, it depends who you speak to. Look, I think, firstly, it's important to understand that there's three tranches to that first home buyer scheme. Firstly, there's the first home guarantee, which, as you said, allows purchasers with just 5% deposit to, as opposed to the usual 20, to not have to pay LMI or lender mortgage insurance. But I guess under the program, buyers can buy a home worth up to $800,000 in Sydney and $600,000 in regional New South Wales. And those caps are at $700,000 in Melbourne and $500,000 in regional Victoria. So it does really limit, the access to certain property that first home buyers might have. I guess you've also got the regional home guarantee, which is the second tranche of it. That means that it's designed to increase the housing stock and help mitigate the huge home price rises in the regions. And the 5% deposit in the regions means that you've got enough to be able to build or buy a newly built property, and you don't have to be a first home buyer for that one. You can be simply someone who's not owned a property for 5 years. So, look, I think that for certain segments of the market, it's a great scheme, but also I think it's quite limited in the people that will benefit from it.
Yeah, well, surely the bottom line, as the real estate agents say, is supply. Because then no matter what incentives are given and no matter how easy it is to get finance, if the supply's there, you're not competing with other people as much. And that's what drove this market up in the first place.
Well, look, that's right. And, as you said, we're going into, quite an uncertain market. Given the threat of interest rate rises and the potential cooling in the market, these first home buyer schemes mean that people can go in with a really slim sort of 5% equity. I think first home buyers really need to consider their circumstances really carefully before they enter the scheme. Because you've got to remember that the government's actually not chipping in for that, that extra 15% for your property. It only backs your loan to the extent that it's exempt from the LMI. So, if you're going in with sort of 2% deposit or, even a 5% one, doesn't give you much equity buffer if prices start to dip. With that falling demand, it leads to falling prices. So first home buyers do need to be careful when they consider these schemes.
And the reason I talk about supply is because even in states like New South Wales and Victoria, the latest data is suggesting that the market prices in those states are still above the caps for a lot of people. So,
absolutely, yeah. I mean, you're looking at median house prices in Sydney of 1.1, 1.2 million, and the cap in Sydney for the scheme is 800,000. So that's really, I guess, forcing the people looking to participate into the scheme to, I guess, look in those outer metro areas or even look at the regional areas.
And look, a lot of us had to do that when we were young, move away from home to find a new home or even to find work for that matter. But it is harder for people in some suburbs where they have a strong family tie and they don't want to be too far away from that family. But unfortunately, that's one of the choices a lot of people have to make. Can you give us an idea of some of the postcodes, Carl, in New South Wales, Victoria and Queensland that are under mortgage stress?
Look, yeah, absolutely. I mean, we're seeing a lot of data come into our platform where people are looking to refinance, and that's across the eastern states, right? They've got the looming interest rate rises on the horizon, and they're looking to see if they can lock in a sharper deal for the long term. And we're seeing that around areas in Victoria like Hoppers Crossing, Mount Pleasant, Doncaster East. In New South Wales, interestingly, it's around some of the more affluent postcodes. the eastern suburbs postcodes, the lower North Sydney postcodes, the likes of Kirribilli, Milson's Point, and so on. And then also in Queensland, it's in regional areas such as Cairns, but also and Toowoomba, but also postcodes such as Springfield around Brisbane. So you really it's in a range of different locations across the eastern seaboard.
I suppose there's a bit of a sociological reason for those postcodes to have mortgage stress, because they might be in aspirational suburbs. People really want to stretch what might be a middle income to get into a high income area. And you can understand that, but people are taking risks to do it. What about the home loan hotspots where first homeowners are, of course, looking to buy, but also existing homeowners are looking to refinance?
Yeah, look, absolutely. I mean, once again, our platform's showing a lot of interesting data across Victoria, New South Wales, and Queensland. I mean, the buy cohort, that buy category, we're seeing that around the likes of the inner west, and also the northwest in Sydney. Suburbs such as Epping and Five Dock, Waterloo, Zetland, but also in regional hubs and regional centres like Coffs Harbour and Dubbo. In Queensland, it's that southeastern region, on the coastal areas, the likes of Burleigh Heads and Hervey Bay and Redcliffe and such. And then in Victoria, it's once again, it's sort of regional areas such as the East Geelong and Ballarat and so on. So as we said before, that's those first home buyer schemes are really driving that that buy cohort out in those regional areas.
Well, as someone pointed out earlier in the week, you should be anticipating up to 5% long term when you sort out a home loan. Is that a fair estimate, do you think, Carl, when you're planning? Because you're a long time repaying that loan in most cases.
Look, absolutely. I think it really depends on circumstances, broadly speaking, if the cash rate goes up, borrowers can expect the banks and lenders to, be increasing their variable rates, and that of course means, much higher in repayments. But if inflation continues, borrowers are really likely to feel a further squeeze, and they're going to be putting more of their income to service the loan repayments. And you've got to remember also, I mean, there's a whole generation out there, or sort of a whole generation of homeowners who haven't seen an interest rate hike. They've only seen the rates go one way over the last 10, 12 years. And, that's, going into this environment where you've got those threat of the looming rises, it's quite an unknown territory for a lot of borrowers.
Yes, and look, it's something that people of an age have already been through and prepared for. Let's hope that generation you speak of is prepared for it as well. Carl Hammerschmidt, thank you so much for your time.
Look, thanks very much, Bill. Great to talk to you.
Cruising is back and Flight Centre is ready to sell.